Just gone 10 o'clock, so I think we'll make a start on today's tax webinar. So first of all, thanks to everybody for joining us for this webinar, which is the final one in our initial series of six webinars. I've got some housekeeping to do before we carry on. First of all, if you're having problems with the connection, then please hit the reconnect button at the top of your screen, and that should refresh you back into the webinar live room. Secondly, please feel free to ask questions as we go, either in the sidebar or by email to webinars@kpmg.co.im, preferably with the word question in the subject field, and we'll try and address those either at the end of the section or at the end of the webinar. In terms of our presenters today, you've got myself and my two colleagues, Katie and Justine. Justine and Katie are probably well known to many of you from our Claremont seminars and other environments, and they both work extensively in relation to private client related tax matters, which is really the subject for today's webinar. So what are we going to cover? Well, as I say, it's going to be focused on personal / private client related tax issues. I'm going to start off by giving a brief and broad overview of some of the measures in the what are now dim and distant UK and Isle of Man budgets from earlier this year, and then some comment on some COVID-19 related matters in both jurisdictions. Katie's then going to give an overview of some key UK tax issues for beneficiaries getting distributions from non-UK trusts, and then Justine will look at the UK tax issues associated with potential restructuring and winding up of offshore structures, and then she'll hand back to Katie, who will briefly discuss the compliance obligations that can arise from such restructuring, and then Katie will wrap up at the end. I mean, it's worth saying that one of the reasons that we're focusing on this area in relation to trusts and restructuring is that in this COVID-19 environment, we are seeing and hearing of increasing demands from beneficiaries and indeed settlors for increased distributions from their trust structures and/or reducing costs of those structures by potential simplification, and that's why we think it's worthy of some discussion today. So in terms of UK and Isle of Man, and I'll start with Isle of Man, back in the February budget when China and COVID-19 was on the agenda, but it certainly hadn't. We weren't aware of it hitting UK shores at that time. The key headline from the Isle of Man budget really was that there weren't really any headlines on the tax front. Tax and national insurance rates were largely unchanged. There was a welcome one-year extension of the National Insurance Contribution Holiday Scheme through to March 2021. If you recall, this is the scheme which gives new residents and returning students a refund of the first 12 months employees' national insurance contribution. So it's potentially quite a financial attraction for those as individuals. Also, as we start to think about a potential easing of lockdown measures, probably a good time to think again about the enactment of the key employee concession into primary legislation. As a reminder, this applies to new residents who are essential to the implementation of and operation of new business on the island, and which will result in additional employment on the island. The regime applies for the first 3 years of residence and effectively means that the individual is only taxed on main source employment income and property income, i.e. they're broadly taxed as though they were non-resident. In many ways, there was no need to legislate for the existing extra statutory concession. It was working perfectly well. But I think there was a feeling that perhaps it wasn't being widely used as it could be, and that by legislating, they would raise the profile of it. So it has been overlooked by some in the past. The one thing that the key employee concession always draws out by the people that are able to avail of it is, what next? What happens at the end of the 3-year period? And the reality is that there is no further favourable regime at the end of the 3-year period. But of course, we do have the tax cap for those very high earners. And within this year's budget, there was the introduction for the first time of a 10-year cap election. And I know this 10-year cap was frowned upon by some, but it is designed to give greater certainty over future possible changes in the regime, and will be of attraction to a relatively small number of those existing tax cappers. And indeed, it has to be said that now more than ever feels like a time to be encouraging successful entrepreneurs to make our island their home. And I suspect the impact of COVID-19 and the lockdown will make many people think about some fundamental lifestyle changes. And I'm sure that most of you would agree that the island is a pretty good place to be locked down in, all things considered. So hopefully, this could be the kickstart of a further influx of wealthy and successful entrepreneurs to the island. In terms of COVID-19 related measures on the Isle of Man, there's just a couple that I wanted to mention. The first was a new practice note that came out at the end of last month relating to working from home, which may be of interest to employers, and it in effect allows employers to pay up to £8 a week or £35 a month to employees in respect of additional costs the employee will be incurring in respect of working from home. And this can be paid tax and national insurance contribution free, i.e. outside of payroll. And there's no obligation on the employee to maintain records or evidence that they've incurred additional expenditure as a result of working from home. The second one is that you may have seen that the personal tax return filing deadline has been moved from 6th of October to 6th of November. And indeed, if you're still filing paper returns, I guess I would first encourage you to file online. It's much better. But if you are filing paper returns, you may have seen that the issuance of paper returns was delayed, with them only coming through doors last week and this week. I suspect many people will in fact probably choose to file their tax return earlier rather than later, potentially having some more time on their hands as they find themselves a little more locked down than usual. Turning on to the UK tax matters, I guess before commenting on the budget measures that were implemented back in March, I guess it's worth saying that there's increasing coverage in the UK now about what the UK Chancellor might do in his next emergency budget to raise revenue in light of the huge deficits that the UK are facing. And indeed, I read a Times article this morning that stated that the UK government monthly spending on furloughing alone was the same as the entire monthly spend on health and social care. It's frightening numbers. And I guess, as with the Manx budget, the UK's budget earlier this year was again fairly quiet on the personal tax and private client tax front. The headlines were probably taken up by the reduction in the lifetime allowance for entrepreneurs relief from £10 million to just £1 million, and indeed the renaming of it to business assets disposal relief, which is probably a better reflection of what it's all about. Essentially, it's the reduction in the capital gains tax rate to 10% on the first £1 million of gains on disposal of business assets, with business assets broadly being shares in a trading company that you have at least 5% of voting value, or assets used in a business. So I guess that reduction in that relief potentially makes the island more attractive to people looking to relocate ahead of a significant business disposal. Second key point that I want to highlight is the increase in the surcharge on stamp duty land tax for non-residents. So it's a 2% surcharge on non-residents buying UK residential property from next April, and this is on top of the 3% surcharge for second homes, and most non-UK residents buying a UK residential property probably already own a residential property overseas, and therefore they're already going to be suffering a 3% surcharge. So the top rate now, or will be from April next year, of SDLT on buying residential property is 17% in the UK. And even buying the cheapest of properties now by a non-resident owning existing property there's a 5% surcharge thereon, so it's pretty significant. There weren't really any other major measures in relation to inheritance tax or capital gains tax in the budget. Some other things worthy of mention, though, are in relation to UK property, it's been hard over the last few years to keep up to speed with all of the changing rules in relation to UK property and UK residential property. With effect from 6th of April this year, UK residents selling UK residential property now have just 30 days to report the gain and pay the tax. And the only exception is if the property was the individual's principal private residence throughout the period of ownership. There is a slight extension for returns due up to 30th of June, in that late filing penalties won't be imposed, provided that you file by 31 July. For non-UK residents, there continues, as before, to be a 30-day filing requirement on disposals of residential property, and there's no longer an option to defer payment until the normal self-assessment return timeframes. Tax must be paid within 30 days of the disposal. There's a new online system through which you can make the reporting. In terms of a COVID-19 related measure and personal residence, as you know, the UK has a statutory residence test with very mechanical rules for determining whether or not an individual is UK resident, which is based upon day counting and the number of connecting factors that individual has with the UK. Under the test, there always has been an exceptional circumstances provision that applies where an individual has been prevented from leaving the UK. By exceptional circumstances, they can discount up to 60 days of presence. And examples of exceptional circumstances in the existing guidance were quoted as national or local emergencies, war, civil unrest, or sudden or life-threatening illness or injury. HMRC has now come out with some specific guidance as to what they will regard as exceptional in the context of people being stuck in the UK because of COVID-19 related circumstances. The penultimate point that I just want to mention briefly is off payroll working, often referred to as IR35, which is probably a webinar of its own. But there's new rules being put in place that currently apply to the public sector are being extended to the private sector, to medium and large private sector organisations. And they put an obligation on those organisations to assess the IR35 status of contractors who operate through intermediaries. So up to now, the onus and bite of the legislation has been on the intermediary or the individual's personal service company, and the end user could effectively have distanced itself from the obligations, and that will no longer be the case. I mean, this whole area has frankly been a mess for many years, and up to now, end user organisations have been actively encouraging individuals to contract to intermediaries, and this has resulted in all sorts of practices, including the problems, that well-publicised problems surrounding the loan charges imposed in relation to historic tax avoidance arrangements. The only good news here really is that the changes which were originally intended to come in from 6th of April 20 have been deferred till April 21. However, COVID-19, along with furloughing and the fact that direct dividend companies, as they've come to be known, have not been able to access some of the salary support schemes, and the general debate about the national insurance differential between self-employed and employed, does lead to questions as whether there's going to be an even more fundamental regime of reform of the regime in this area before we even get to April 21. And the final point I just want to mention really is that the Finance Bill 2020 contains a couple of provisions and clarifications relating to trust additions and transfers between trusts involving settlors that have effectively changed domicile during the period of the trust, and they deal with whether or not property is treated as or remains excluded property. If this is a potential relevance to your structures, then you really need to watch out for it and look in more detail. And on that note, at this stage, I think I'll hand over to Katie, unless we've got any questions that need to be dealt with at this point. Hand over to Katie to give to start her session.
Thanks, Dave, and good morning, everybody. As Dave mentioned, we are seeing individuals and businesses struggling as a result of the current COVID-19 situation. And we have seen an increase in beneficiaries requesting distributions from offshore trusts. So I wanted to take the opportunity to provide a high-level refresher of the potential UK tax implications for UK resident beneficiaries receiving distributions from a non-UK resident discretionary trust. And just to point out here, I am only covering discretionary trusts, not interest in possession trusts, otherwise we could be here for quite a long time. So firstly, let's have a look at trusts that are not settlor interested. So for income tax purposes, a trust is settlor interested if the settled property is, or will, or may become payable to the settlor or their spouse in any circumstances whatsoever, or where a minor child of the settlor can benefit from the income of the trust, or where the settlor receives a capital sum from the trust. As such, unless the settlor and their spouse are specifically excluded from the trust, or the settlor is dead, it is likely that the trust is settlor interested for income tax purposes. In contrast, a trust is settlor interested for capital gains tax purposes if the settlor, their spouse, their children and grandchildren, or any of their spouses is an actual or potential beneficiary. This is a much broader definition than the income tax equivalent, and it is not uncommon for a trust to be settlor interested for capital gains tax purposes, but not for income tax purposes. There are some exceptions to both the income tax and CGT rules, which I'm not going to cover here. So assuming that we're dealing with a non-UK resident discretionary trust that is not settlor interested for income tax or capital gains tax purposes, and the trust makes a distribution to a UK resident beneficiary, what are the UK tax consequences for the beneficiary? The UK has various anti-avoidance provisions that apply to non-UK resident trusts and their underlying companies where there are UK resident trust beneficiaries. The broad effect of the UK's anti-avoidance provisions is to tax UK resident beneficiaries on benefits received from non-UK resident trusts as income or capital gains, to the extent that they are matched to relevant income or stockpile gains. This is often referred to as the benefits charge. A benefit includes a simple distribution of cash, as well as, for example, interest-free or low-interest loans and rent-free occupation of a property owned within the trust structure. In the case of a loan, which trustees may see more demand for in the coming months, the value of the benefit is equal to HMRC's official rate of interest, less any interest actually paid. Under Section 731 of Income Tax Act 2007, a charge to income tax arises where a UK resident beneficiary receives a benefit from a non-UK resident trust to the extent that the benefit is matched to relevant income. Relevant income is income that is available to provide a benefit and is the income net of all losses, costs, and other expenses or outgoings, including taxes, i.e., it's the amount of income that is physically available to provide a benefit. And in this context, income includes income arising to the trust itself, and under Section 720 of Income Tax Act 2007, income arising to a non-UK company owned by the trust. The computations for determining the amount of relevant income in a trust structure can be complex. One point to note is that under Section 743 Income Tax Act 2007, there is no double counting of relevant income. So if, for example, a trust owns a non-resident company and income arises to that company, that income is relevant income for these purposes. If the company then pays that income to the trust in the form of a dividend, the income ceases to be relevant income at the company level, but becomes relevant income at the trust level. If there is no relevant income, under Section 87 of TCGA 92, the beneficiary could be liable to capital gains tax to the extent that the benefit is matched to stockpile gains, being the net chargeable gains of the non-UK resident trust. In addition, capital gains arising to an underlying non-UK resident company may also be included in the stockpile gains pool under Section 3 of TCGA. Unlike relevant income, stockpile gains can be double counted. So taking our example of a trust owning a company, if the company realises a gain, it is added to the stockpile gains pool. If the company is then liquidated, a gain will arise in relation to the shares the trust owns in the company, with the result that the same economic gain is added to the stockpile gains pool again. Offshore income gains need to be calculated and pooled separately, and these arise on the disposal of non-reporting funds, which are a common feature of investment portfolios held in offshore structures. The gain on the disposal of a non-reporting fund is taxable as income and will be matched to a benefit to a UK resident beneficiary before stockpile gains. Benefits that are not matched to relevant income, offshore income gains or stockpile gains, are carried forward and matched to future income and gains arising within the trust structure. UK resident beneficiaries are liable to UK tax in the tax year the income or gains arise. Both the income and capital gains tax provisions are subject to motive defences, which, if accepted by HMRC, generally prevent trust benefits from being subject to UK tax, with the exception of capital gains arising directly to the trust. The chargeable gains motive defence tends to be more robust than the income tax motive defence. However, the availability of the motive defence, whether for income tax or capital gains tax purposes, is complex and very fact-specific. If the beneficiaries do claim the motive defence, it is likely that HMRC will inquire. UK resident beneficiaries who are liable to UK tax under remittance basis of taxation will only be subject to UK tax to the extent that the benefit is remitted to the UK. Whether a benefit is remitted to the UK in the case of cash distribution is usually relatively simple to determine, but in the case of other benefits such as loans or the provision of services, it can be more complicated and worth exploring in detail. It's important to remember that for UK tax purposes, the UK tax legislation overrides trust law. So whilst a distribution to a beneficiary may be classified as a capital distribution for trust law purposes, it could be taxed as income or capital gains in the hands of the UK resident beneficiary under this legislation. So non-UK resident trusts with UK resident beneficiaries need to keep updated calculations of their relevant income and stockpile gains pools, matching them to any benefits to the UK resident beneficiaries on an annual basis. As I mentioned earlier, these calculations are not always simple. Moving on to settlor interested trusts. This can be a particularly complex area following the changes in UK tax legislation from April 17, and the UK tax position of the settlor very much depends on the residence and domicile position of the settlor themselves and whether or not the trust has been tainted. I have assumed here that the settlor is UK resident for tax purposes. You will recall that the UK changed its deemed domicile rules with effect from 5th of April 2017. Prior to that, deemed domicile only applied in relation to inheritance tax, but since then, deemed domicile impacts an individual's income tax and capital gains tax position, in particular the ability to claim the remittance basis of taxation and the taxation of the individual as a settlor. Individuals who have returned to the UK and are UK resident, born in the UK and have a UK domicile of origin are deemed to be UK domiciled even if they have acquired a domicile of choice elsewhere. And I refer to these people as returners. And I refer to individuals who are deemed UK domiciled as a result of being UK resident for 15 out of 20 prior tax years as long stayers. Certain protections are available to long stayer settlors unless the trust has been tainted, which occurs when property or income is added to a trust at a time when the settlor is UK domiciled or deemed domiciled. So starting with the relatively simple case of a UK domiciled settlor, including returners, such settlors are subject to UK income tax on the income of the trust on an arising basis under section 624 of ITOIA. If the trust is in receipt of UK source income, typically the trust will be required to report the income on a trust and estate return and pay the UK income tax, with the settlor then claiming a credit for the trust tax paid on their UK self-assessment tax return. Unless the motive defence applies, the settlor will also be liable to UK income tax on the income of underlying companies on an arising basis. Under section 86 of TCGA, a UK domiciled settlor is liable to capital gains tax on gains arising to the trust as they arise, and on any gains arising to underlying companies if the motive defence doesn't apply. You might think that, as a result, a UK resident and domiciled settlor will not be liable to income tax or capital gains tax on a distribution from a trust. However, if there is income available at the trust level that has not been attributed under section 624, for example, the settlor was non-UK resident for a time and received a capital payment, which could include a loan, a tax charge may arise under section 633 ITOIA. Similarly, a capital payment could be matched to previously unmatched capital gains or offshore income gains. So moving on to deemed UK domiciled settlor, where the trust is not tainted, these settlors will be liable to UK tax on any UK source income or chargeable gains and any offshore income gains arising to the trust, but not in relation to other foreign source income or gains. Instead, the settlor is liable to UK tax under the benefits charge outlined earlier, i.e. liable to income tax and capital gains tax in relation to any benefits received to the extent that they are matched to relevant foreign income. However, where a trust has been tainted and the settlor is deemed domiciled as a long stayer, they will be liable to income tax and capital gains tax in the same way that a UK domicile settlor is, i.e. liable to tax on the income and gains as they arise. The sting in the tail here is that they will also be liable to UK tax under the benefits charge rules to the extent that income or gains arose before the trust was tainted. Where the settlor is non-UK domiciled, they will be liable to UK tax on UK source income and gains on an arising basis, as well as offshore income gains unless the remittance basis applies. However, they will be liable to UK tax under the benefits charge subject to the operation of the remittance basis of taxation. There are also provisions to consider if benefits are paid by the trustees of a settlor interested trust to a person who is not the settlor. There are various provisions that could result in either the settlor or the other person being liable to UK tax as a result. These are complex rules, and unfortunately I don't have time to cover them here, but it is something that needs to be examined in detail on a case-by-case basis. And finally, trustees and beneficiaries need to be mindful of making indirect distributions and the onward gift rules. Benefits provided the non-UK resident beneficiaries who then make an onward payment to a UK resident may result in UK tax charges for the UK resident, even though they have not directly received a benefit from the trust. Prior to April 18, HMRC could challenge a UK resident's tax position on the receipt of indirect payments from a non-UK trust using a combination of UK legislation and case law. From April 18, specific legislation was introduced in relation to onward gifts, although you should bear in mind that the pre-April 18 position also remains in force. Of course, the financial situation of beneficiaries or shareholders may mean that the beneficiaries require the entire trust fund, leading to the winding up of the trust structure in its entirety. Justine is going to talk through the various UK tax issues that could arise as a result. Each situation is unique, so trustees need to give careful consideration to how best to wind up a structure. So I'll hand over to Justine.
Thanks, Katie. Hopefully everyone can hear me. Good morning, everyone. It's great to see so many people online joining us this sunny morning. So, as I'm sure you'll all agree, COVID-19 without a doubt has and continues to have a dramatic impact on individuals and businesses worldwide. The pandemic has caused all of us to change how we live and work, and has not only put a lot of pressure on the economy, but has made it hard to plan for the future. From a tax perspective, we've seen the introduction of new tax initiatives and concessions, and all of this has emerged in a piecemeal fashion, making providing tax advice more difficult. However, as Dave has mentioned previously, one area that we have seen a particular focus on is the winding up of offshore structures or general restructuring. Whether this is because there's been more time at home to ponder about the efficacy of such structures, or the fact that market values of underlying assets are currently low, presenting an opportunity for tax savings, or whether the need to save costs wherever possible is even more apparent in the current climate, it appears that the knock-on effect of the pandemic is a focus on simplifying and reorganising. So, when are offshore structures still worthwhile and when are they not? In more cases than not, the reason for winding up or restructuring is because the offshore structure is no longer tax efficient. For example, as a lot of you attending this webinar will already be aware, for many years, it was common practice for a non-UK domiciled individual to hold UK land and property in an offshore trust and company structure, particularly where that UK property was occupied by that individual and their family. As this next slide shows. The tax effect of this was that a trust created by a non-UK domiciled individual, which only held non-UK property, being the shares in the offshore company, would be outside the scope of UK inheritance tax. In addition, holding the UK property in this way would also in some cases prove to be more beneficial from a capital gains tax perspective when the property was ultimately sold. As such, generally, this kind of basic structure could be very tax efficient. However, the taxation of UK property has changed significantly over the years. The annual tax on enveloped dwellings, or ATED, was introduced in April 13. We then had non-resident capital gains tax from April 15 and inheritance tax from April 17 for residential properties. And then more recently, capital gains tax on commercial properties and indirect disposals of property-rich companies, which apply from April 2019. Let us also not forget that any rent-free occupation of residential property held within an offshore structure by a beneficiary is a benefit that is also potentially charged to UK tax. Therefore, in most situations, the holding of UK property for personal use in this kind of structure is no longer tax efficient. The solution to this problem might be simply removing the offshore company from the equation rather than completely winding up the whole structure, so the trust ends up holding the property directly. Or it might mean taking this a step further and distributing the property to a beneficiary to be held personally. On the other hand, if the structure is used to hold rental properties with significant income streams, there may arguably still be some benefit in maintaining the structure to benefit from lower income tax rates and higher interest relief. Other reasons for restructuring may be to simplify and therefore reduce overall running costs, where the structure includes a number of companies and/or trusts. This may be the case where the structure includes a number of companies holding individual assets, so consolidating may be an option, or where the structure includes a number of trusts with the same beneficiaries and the need for separate trusts are no longer required. Alternatively, the trustees may not have a choice if funds are needed to distribute to beneficiaries to fund living expenses and/or failing businesses. Okay, so once the decision has been made to restructure or wind up, how can any restructuring be done tax efficiently? I'm going to focus today on the tax implications of the winding up or restructuring of an offshore trust and company structure that holds UK property, so as we've just seen on the last slide, as this is one of the more typical offshore structures that we come across. Broadly, there are two potential options. The first one is that the offshore company could transfer all of its assets to the trustee as a dividend in specie prior to either a voluntary liquidation or dissolution of the company. Whether the trustees decide to liquidate or dissolve the company is a separate matter, but does also need to be considered in terms of cost and potential future liabilities of the company. The second option is that the assets of the offshore company could be left in the company, and in the course of the liquidation of the company, the assets are transferred to the trustee. The key point here being that if the assets are transferred as part of the liquidation process, this should be treated as a capital transaction as opposed to income as per the dividend in specie route. So looking at these two options in a little more detail in this slide and the potential tax consequences of each, you can see that the key takeaways from this slide is that the dividend in specie prior to liquidation route can create relevant income in the structure, while the transfer of assets in the course of a voluntary liquidation route creates stock par gains instead. The downside, of course, of having more relevant income in the structure under the dividend in specie route is that future distributions of assets or cash to UK resident beneficiaries can be taxed at higher income tax rates, up to a maximum of 45%, as opposed to capital gains tax rates at a maximum of 20% under the matching principles Katie has just talked to us about. The voluntary liquidation route, however, can give rise to two immediate tax charges: corporation tax at the company level and capital gains tax at the trustee level, although these charges may not be significant in the current climate due to low market values and the potential to rebase property and shares to their April 15 or 19 value as appropriate. The voluntary liquidation route will also create stock par gains, which may be avoided if the dividend in specie route is chosen, and the Section 3 TCJA motive defence applies. Because if this defence applies, it effectively stops the capital gain from being attributed up from the company to the trust level to be matched against distributions to UK resident beneficiaries. There may then be a further UK tax charge on any distribution of the property to the beneficiary. And also, there may be immediate CGT charges for beneficiaries in relation to any historic rent-free occupation of the property if up to now there was no relevant income or stockpile gains within the structure to match against this benefit. The distribution of the UK property by the offshore trustees to the beneficiary will also be a chargeable event for inheritance tax purposes, and inheritance tax forms will need to be completed and filed even where there is no inheritance tax liability. And finally, stamp duty land tax may also be payable where the company has outstanding borrowings, and the UK property must be transferred subject to that debt. Notwithstanding all of this, more often than not, in our experience, the most tax efficient route is to liquidate the company and transfer the assets in the course of that liquidation, and then, if desired, for the trustees to distribute the property to the beneficiary. Alternatively, the trust can be kept holding the property directly, and this can be tax efficient if this trust is not settlor interested. So in cases where the settlor is not a beneficiary of the trust, as there are still inheritance tax benefits of retaining the trust, with only 6% inheritance tax charges every 10 years, as opposed to 40% for each generation if the property is held personally. Also, where the property is occupied by a beneficiary of the trust, principal private residence relief may be available for capital gains tax purposes when the property is eventually sold, which would not have been the case if the underlying company continued to own the property. So you're probably thinking that the safest bet is just to wind up a structure or restructure by transferring the assets of the company in the course of a voluntary liquidation. But you should remember that this might not always be the right decision, as there are situations where making a dividend in specie of all of the assets of the company prior to liquidation is more tax efficient, particularly where there are several companies within the structure and/or significant relevant income has already been generated. The reason for this is that a dividend in specie of the assets will be treated as income in the trustee's hands. But if this income has already been accounted for as relevant income at the company level, it will not be accounted again for at the trust level, which means there could be a capital gains tax saving when compared to transferring the assets on liquidation. Finally, before we look at some of the key matters to consider before winding up or restructuring, it's worth noting that there may also be a third option, which is kind of a mixture of the two options I've already mentioned. And this is for the company to pay a dividend of any cash reserves to the trustee prior to transferring the assets on a voluntary liquidation. The tax benefit of this is that the dividend will not be double counted as relevant income, as I've just mentioned, and may also reduce the potential capital gain arising to the trustee on the ultimate liquidation of the company by reducing the value of the shares for capital gains tax purposes. Whichever option is chosen, there will be tax compliance obligations for the trustees and/or the company to consider, and therefore tax returns will need to be completed. And Katie will tell us what these reporting obligations are in more detail in a minute. So to conclude, there are, as usual, a number of matters to consider before winding up or restructuring, including whether the structure contains residential or commercial property, because maybe the structure is still tax efficient, as there are still inheritance tax benefits and no ATED for commercial property. What are the relevant income stockpile gains of the whole structure, and who will ultimately benefit from the structure? If there are only non-UK resident beneficiaries, perhaps creating relevant income will not matter so much. Is the company income producing? And was the company created for trading or investment purposes? If trading, it may be that any profit arising on the sale of any assets would be income as opposed to capital gains for UK tax purposes. Is the structure settlor interested or for the use of another beneficiary? If settlor interested, it may be less tax efficient than if the trust is exclusively for another beneficiary. What are the future intentions regarding any underlying property? For example, will the property be sold in the near future, or will it be retained for future generations? Is there any debt on the property that may give rise to stamp duty land tax charges? And will it be necessary to consider general anti-avoidance rules, depending on who the debt is with and whether it can be repaid? Is there any underlying property being occupied by a beneficiary? And would principal private residence relief be available on sale if held directly by the beneficiary or directly by the trustees? Is rebasing available to values at April 15 or 19? So could it be a good time to do it now while market values are low? Are there other assets within the company other than property, as this can be beneficial when valuing shares for inheritance tax purposes, particularly if there is debt? Above all, though, it should be noted that there is most likely to be an immediate associated tax cost of winding up or restructuring, but this can be mitigated if the process is managed correctly. And anyway, long-term tax savings might make this a price worth paying. And also don't forget that there are also costs associated with dissolving or liquidating a company. Dissolution is much more straightforward and a less costly procedure than liquidating the company, but the primary risk is that the company may be reinstated, and thus the liability of every director, officer and member of the company continues and may be enforced at a later date. Dissolution is generally only advised where there is no issue with regards to the assets and liabilities of the company. It is therefore critical to carefully review any offshore structures to determine if they still achieve the desired effect now and into the future, and if not, to obtain professional tax advice as to how winding up or any restructuring may be achieved in the most tax efficient way. Our advisory team here at KPMG can also assist with the liquidation of a company, so please feel free to contact us for a quote if this is something that you or your clients wish to pursue. So on that note, I will pass you back to Katie, who will talk us through some of the reporting obligations that may arise in relation to any winding up or restructuring.
Thanks, Justine. So as you can see, there are several potential tax points when you wind up a trust structure. Where there is a UK tax liability, and sometimes even where there is no liability, the trustees and the underlying companies may have a UK compliance reporting obligation to meet, which I'm going to briefly run through. If the trust is a relevant property trust, has distributed UK situs assets or shares in a company owning UK residential property, the trustees will need to complete and submit Form IHT 100 and Event Form IHT 100C, along with any relevant supplementary pages. If the trustees are not already registered for IHT, they will need to complete and submit Form IHT 122 to obtain an IHT reference number before they can file Form IHT 100. The IHT 100 form must be submitted by the end of the 6th month after the distribution, which is also the IHT payment deadline. If the trustees dispose of UK land, either by selling or distributing it, they will need to report the disposal using HMRC's capital gains tax on UK property service. Prior to 6th of April 2020, trustees would file an NRCGT return. So this is regardless of whether there is CGT to pay or not. The trustees will need to create a capital gains tax on UK property account and report the disposal and pay any CGT within 30 days of the date the interest in the land is conveyed or transferred. For indirect disposals of land, for example, the transfer of shares in a property-rich company, the trustees must file a non-resident capital gains tax return within 30 days, paying any CGT due within the same 30-day period. When an underlying company disposes of UK land, if it is not already registered for corporation tax, it will have to do so within 3 months of selling, gifting, or transferring ownership of the land. If the company has no other business in the UK, it will only need to file a single return for the date of the disposal, and it will have a 1-day accounting period. If it has made more than one disposal, it will need to file a new CT return for each disposal. If the company has been receiving UK rental income, it should already be registered for corporation tax from 6th of April 2020 and will need to include the disposal in its corporation tax return. The corporation tax return is due 12 months after the end of the accounting period. The payment deadline will depend on the company's taxable profits and length of accounting period, but it is usually 9 months and 1 day after the end of the accounting period. However, the rules for paying in instalments may mean the corporation tax is payable on the date of the disposal. If an SDLT charge arises as a result of UK property being transferred within the structure, for example, as a result of the transfer from an underlying company to the trust, the SDLT return and payment are due within 14 days of the effective date of the transaction, which is usually the date the transfer completes. Bear in mind, there are different rules for property in Wales and Scotland, where you'll be dealing with land and buildings transaction tax in Scotland and land transaction tax in Wales. The trustees will also need to consider whether they are required to register on the UK's Trust Registration Service. If the trust is not already registered and a liability to IHT, CGT or SDLT arises, the trustees will need to register the trust. The CGT, the registration deadlines are 5th of October following the end of the tax year if the trust doesn't have a UK tax reference, or 31 January if it does. For IHT and SDLT, the deadline is 31 January following the end of the tax year. Finally, where you have multiple transactions at different levels within a trust structure, different entities within the structure may end up filing returns in relation to the same property. For example, suppose a trust owns a company, which in turn owns a UK property. If the company distributes the property to the trust, the company will need to report the disposal on a corporation tax return. If the trust then distributes the property to a beneficiary, the trustees will need to report the transfer using HMRC's capital gains tax on UK property service. The trust will also need to submit an IHT account and may need to file an SDLT return depending on the circumstances. So as you can see, depending on how a trust structure is wound up, there could be multiple returns to be submitted, different filing and payment deadlines to consider. So that brings us to the end of our presentation today, and I'm just going to ask Dave if there are any further questions that have come in while we've been talking.
Yeah, thanks, Katie. I think we've had two questions come in, one through the public chat and I think one on the private chat. The first question is in terms of indirect disposals of property-rich companies, and the question really is how you look at the test. So if you have a say an Isle of Man company where 74% of its gross asset values are UK property and 26% of its gross asset values are, say, a portfolio of equities that are not property rich themselves, does that work as non-property rich? And the answer is yes, it does, because the test is 75% or more of the gross asset values being UK property. So hopefully that's clear. And the second question we've had in is, can an already resident tax capper sign up for the 10-year commitment? And the answer to that is yes, they can re-elect for a new 10-year commitment. So I think that's the only questions we've had in, Katie.
Okay, thank you to my colleagues David and Justine, and to all of you for joining us today. All of our webinars and slides are available to watch on our website, and today's webinar will be available later this afternoon. Details of the next webinar will be circulated shortly. I hope you all enjoy the rest of your day. Thanks.